Hey, good morning, everyone. Marty Mazur here, the 6th of November, 2024, with a quick, call it interim video commentary for you. With the election results and what the market's doing today, I feel compelled to just pop in and just give you a few minutes worth of my thoughts. And I thought I would, for my prop today, use the notes that I put into our internal log on October 26th, about 2 weeks ago. And what I was doing there is I was kind of just putting to words for staff, and my co-CIO Nick and I work on these things together as well in terms of our theses. And then of course we leverage the economists and analysts who we pay for their input and their theses and so forth. And here's what I was kind of pondering if we got what we got last night. So what I did here is I wrote about kind of what that should look like, and what I really want to get to is the chart of the previous Trump administration and the dynamics around the stock market moves, when he was president the last time. And so there's still some uncertainty around the House. The Republicans took the Senate, of course they took the White House. The race in the House is still yet to be determined. The Republicans have had control. All indications are, I believe, that they're going to maintain control. So it looks likely that there's a full Republican sweep. So let's just assume that when the president takes office, President Trump, that he's going to have a lot of support for his policies. So I thought that we would take a look at how that played out the last time and why, and how different the general underlying conditions are today versus last time, and kind of gauge what we should be taking advantage of, what we might be hedging against, and so forth. So what I did here, as you can see, is I went back to literally election night 2016 and charted the S&P 500. So as you can see, from election night, as you can see and as you probably remember, after the initial sell-off when the news was announced due to fear that he was just going to go right at protectionism and tariffs and so forth, after that waned because he talked really more about tax cuts and deregulation and business tax incentives, real market-friendly stuff, well, we had just a rip-roaring rally all the way through the end of 2017. It was the beginning of 2018 when the trade war rhetoric came to the fore, and mid-2018 when trade war reality, the across-the-board tariffs and so on, hit as well. So I thought it would be a good idea to kind of track the market action during that period, or when that really became the political narrative globally. So from the peak, in early 2018 to the fall of 2019, it was a virtual straight line with mostly downward volatility, 10% correction, 20% correction along the way. Not that this was the only factor in the market dynamics, but clearly it was the headline factor for sure. We got to August of 2019 and we were bullish all the way up to then. There was nothing about our macro research that said we should be defensive until we got to August of 2019. That's when things began to turn red, and we decided to put on an options collar just in case. I was concerned that maybe our signal was a false signal because of all the uncertainty and the trepidation around the trade war may have been impacting economic activity and the data. So I thought, rather than change up the portfolio, let's just put a collar, save our 18% year-to-date gains, and just protect against the downside. By the time we got to December, and this was still before we were thinking about COVID, the recession reality became more real. That's where we added gold, which has been a great trade for us all this time, and so forth. And I did, though, tell you in several videos at the time that the Fed probably already sees what we're seeing. And of course, they're talking about how great the economy is. It's their actions that are going to tell us how they really feel. And sure enough, they started cutting interest rates. I said the market's going to love it, but this is not a fundamental backdrop that we want to take the kind of risk that we were comfortable taking all the way back to like 2009 in this environment. So we might not look very smart for a while, but if we have that recession, the U.S. corporate debt market is an unmitigated disaster. It was at that point. At that point, legally, the Fed couldn't rescue it. So we were expecting something really bad to the downside. Well, when COVID hit, we got a 40% hit, just under 40% intraday over 3 weeks, and we had the briefest recession in history. So what we could not anticipate was that the Fed would actually break the rules and create a facility that allowed them to rescue all the hedge funds and all the private equity firms that were exposed to massive dissolution or default risk in a lot of U.S. corporations. They got bailed out again. Okay, well, similar to 2008, only they could not let the consumer crash and burn this time. So we ended up with, total of 11 trillion in fiscal and monetary stimulus. So the recession that could have been pretty bad got averted with all that stimulus. So then we got to 2022 and we got that bear market. It was about 30% intraday, peak to trough. It was 20 something on a closing basis, but it was noticeable. It wasn't really recession risk that sparked it. It was inflation risk. Of course it was. You throw that much money into the economy with all the residual bottlenecks from COVID. Plus, as I've written volumes about the last few years, we have crossed the Rubicon into a very populist world with real structural inflationary forces that mean inflation is going to be, on average, much higher over the next decade to several decades than it was over the last 40 years or so. And that is a strong, fundamentally sound thesis in our view that makes a difference in terms of how you allocate assets. But in here we were saying recession risk has come back to the fore, and so we're going to see some real disinflation, and the market's probably going to like that until recession hits. Hence, we've had this nice, rally to all-time record levels, and I can say virtually across the board in terms of the major averages, the S&P in particular and the NASDAQ, virtually all-time record valuations, and I've illustrated that for you as well. The kind of valuations that historically have not resolved without something significant to the downside before it's all said and done. And I mean more significant than what we've seen so far. But now we've got, a big, change in the narrative, right? A change in the story that is going to push for lower corporate taxes, right? More incentives, definitely some deregulation, okay? Now, in 2016, I can say this with confidence, the market could absorb. Some would say the market needed that, and I guess it did to extend, what had already been like the longest bull market in history and the longest expansion ever. To extend that at that stage, we needed and could absorb. And when I say we could absorb, we could do it without exacerbating inflation. So this was just manna, right? This was just beautiful. And markets loved it. At the time, we had core CPI at 2.1%. We had a Fed funds rate at 0.5%. We had a 10-year yield at 1.8%. And we had the S&P trading up, but not, scary valuations at 19.7. Okay. The key there was, though, we can do this without yields blowing out, without inflation blowing out. But so now, again, we're talking about the same sort of policies. And as I speak, at least on the surface, it looks like the market is loving it. And I'll give you a little bit of below the surface reality, even in today's market. But folks, today we were looking at a Fed funds rate that's 5%. Now, tomorrow it should go down to 4.75%. But I do think the Fed has to be asking themselves, at a 10-year Treasury rate that I think is above 4.4%. I don't have it in front of me. It was 3.87% a few days ago, right? It's 4.4% today. Yes, bonds are getting destroyed. TLT, the long-term Treasury index, is down 3.25%, which means rates are rising today. And folks, the Treasuries that thing tracks, also reflect mortgage rates as well. So back here, we didn't have that worry. Today, we have an inflation and interest rate worry. 26.5 is dramatically higher than 19.7 on the price to earnings ratio for the S&P. This is an unsustainable valuation long term, and I don't care who tells you it's different this time. I've been doing it for 40 years, and it was different during the tech bubble, but it wasn't. It was different in all the the corrections and bear market since then, this is just too high. And PEs and multiples are highly dependent on the discount rate or on interest rates. And if interest rates are going to go higher because these policies are very stimulative, you can really ask the question, are they really stimulative if interest rates are going to go that much higher? Think about the housing market, think about the auto loan market, think about everything. Now, banks are loving it because they can charge more on loans. Their net interest rates, their net interest margins go up. Bank stocks are up 5.6% as I speak. That's just an insane rally. So they're enjoying the prospects for deregulation and higher interest rate margins. Typically, higher yields like we're getting today would be a massive headwind for stocks across the board, as would a higher dollar that's up, 1.6%, massive move for the dollar. As I've illustrated for you for months, if not years, typically when you get big spikes in interest rates and big spikes in the dollar, you get big down spikes in stocks. None of that is happening today, except if you're invested in, for example, silver, which has had a really nice rally of late. I think our silver position, it was up about 40% as of a week ago, down 4% today. So 10% of that gain is gone in a blink of an eye. Gold is down almost 3%. Now, gold is not our biggest sector weighting, if you will, but our second biggest individual position in our core portfolio. And gold, as I've illustrated the last few weeks on the charts, looks very precarious to me, technically speaking. So I've been calling for a correction in gold anyway. And I said 2 weeks ago, we're probably not going to hedge it. We love the position long term. Well, we changed our mind this week, and day before yesterday, we hedged for anything below a 3% decline. So even though gold's getting hammered today, the gold hedge that we put on is mitigating a good chunk of that decline in our core portfolio, and we're protected against anything dramatic to the downside. So this move today, in the election results, and we're still waiting on the House results. So it looks like that's probably going to go Republican as well, and there's going to be a clean sweep. But that still remains to be seen. So if there's a surprise there, we'll see how the market reacts to it. But like right now, as I speak, healthcare is flat. It's not up at all. Healthcare stocks are not up at all. Consumer staple stocks are down almost 1.5%. Those are your big companies, your Walmarts and so on and so forth, where people spend money. For some reason, they're selling off big time, right? Real estate, our real estate position is down 3.4%. Now, you think Donald Trump and real estate should be synonymously positive? No, because there's such an interest rate sensitive sector. I mentioned commodities are getting trounced. International exposure is, of course, getting trounced right here as well, but for obvious reasons and so forth. Brazil is actually pretty flat. We have a small position in Brazil. It used to be bigger. It's looking very interesting to us. In fact, there's lots of things, folks, that are looking very interesting to us. And we have, things dialed up that if certain trends continue, that we will be adding to positions or introducing new positions. Small caps has been very interesting to us lately. It's having a rip-roaring rally today. Small caps stocks tend to do relatively well in a higher dollar environment because they're so domestically oriented. If the U.S. citizens' purchasing power improves, well, then domestic stocks should do very well. The big multinational companies, which are also up today, the tech stocks today, that, of course, should be called into question if that's sustainable, what we're seeing today. But it's really mostly about banks and, of course, smaller banks as well. We may start incrementally adding small caps. We typically don't go big there until we're like at the bottom of a recession and about to enter a new cycle. But we could add some exposure there given these dynamics. We haven't yet, but we're certainly not on a 5% up day. But the problem with small caps right here is they've also been incredibly interest rate sensitive the latter part of this cycle. I mean, that's every time they start to rally, it seems to get creamed when yields spike. Well, today that's not happening. So we'll see how that dynamic plays out as well. But when we look across the market, like 35 to 40% of the S&P 500 stocks have actually been down all day, while the S&P is actually up 2%. The Dow is still up 1,300 points, and that is largely what's going on with the big financials there. Now, those of you who watched my end-of-week video last week may recall that I told you that in the options space, there was massive purchasing of put options on the S&P and of course on some individual positions, and I'm sure on financial stocks, just in case the election went a different way. Also hedging last week's jobs number, also hedging probably to some degree tomorrow's Fed meeting. But even if folks were hedging tomorrow's Fed meeting, remember the dealers who are on the other side, the counterparties to those put buyers, they get destroyed if the market goes up and those put buyers make a lot of money, right? So what happens is those dealers were having to short the underlying securities. The volatility index, which measures some of that, was up significantly. It's down 20% today. So what happens is now a short position has to be covered. It's a borrowed security that has to be given back. So these dealers, not because they're bearers, but the people they're selling puts to in massive, record quantities. So they're having to enter short positions on the underlying security so that they don't go out of business if the market did indeed tank. So the market didn't tank. The market got the result that clearly it wanted based on the initial reaction. So now all those short positions are covered in a mad dash. So I said this the other day, that there was the potential for a massive rip your face off rally, not because of fundamentals, not because everybody is just incredibly bullish, because all these dealer hedges have to be covered if this thing moves higher. So that happens and that exacerbates the upside. Then everybody's bullish. So now you get a bunch of call positions getting entered into. So the dealers sell those calls. Well, now they're exposed to the upside, so they have to actually buy the underlying security to protect themselves if this thing just continues to melt to the moon, right? Higher. And so there's that other side of the trade that if that comes off and then they have to, and then the market goes the other way, they have to sell those positions. But right now, the setup, and I said this last week, the setup for a rip your face off rally was there, not necessarily fundamentally, that's part of it, but a big chunk of it is what's called short covering. So it's always good to understand the under the surface dynamics so we don't get carried away. Now clients, of course, this is mostly for you, and I know you leave those decisions up to us, so we're not worried about you getting caught on some FOMO trade, fear of missing out, because we do understand the underlying dynamics. But the go forward dynamics of all this are very, very interesting and maybe not as intuitive as you would think given the setup right now versus 2016. It is very, very different. It's a very different dynamic. And what I said in my narrative to our troops internally here is that it's all about what the new administration leads with. If they lead with these very business friendly policies here, there's a real tailwind for stocks. Problem is we've got a real headwind with interest rates and inflation, and that's being expressed today. Clearly, bonds, gold, silver, real estate, they are giving a vastly different signal today intra-market. I mean, they are down as much or more than everything that's up, right? They are giving a very different signal about what all this means, okay? That wasn't the signal we were getting back in here. I think everything was rallying. I'll have to look, so don't quote me on that, but it was different than today. So the dynamics are very, very different. If he really pounds the protectionism right off the get-go, remember when that was at the forefront, it was a messy time for the market, right? So for this market to sustain itself to the upside well into next year, when he takes office, this is what he needs to focus on. And he may know that too. Problem is, though, does this sort of thing really provide stimulus? Again, look at what real estate's doing today. Look at what much of the commodity place is doing today. Utilities, I didn't mention that. They're down 1.25% today. Consumer staples, I think I did mention that. I did. They're still down 1.5%. So we're not getting this entire market. We're getting mixed signals. Bonds and gold are saying one thing. Tech stocks and financial stocks are saying something else. So we do think there's opportunity here. We do think that there is still some real risk. Anything that pushes interest rates higher is actually a tightening of financial conditions, the dollar going up. That's something that's a strain on the economy. So folks, I could ramble and make this a real confusing just ramble session. just know that uncertainty is there. There are some spots that we probably will begin to scale into a bit to take advantage of these dynamics. But make no mistake, this is not a market going into next year that you want to just push all caution to the wind. Not at, call it 27 times earnings, I'm sure, after today. And if you didn't watch last week's video, please go back and watch that. I talked about where there's some valuation opportunity in the market, but I pointed at technology, and I made some pretty startling comparisons to when we were here before. Doesn't mean things are going to play out like they did historically, as I've been pointing out. Things are very different, but the things that are the same, are somewhat concerning. So anyway, folks, we've enjoyed a pretty good year this year so far, particularly for the risks that we've taken or not taken. And I still think that on balance, particularly the way flows and positionings happen at the end of the year, could be a pretty good run for the market between now and year end. But uncertainty certainly prevails, and you don't need to look any further than the intermarket action so far today. So we will keep updating you on the world as we see it, and clients will continue to act and protect and take advantage of things accordingly within your portfolios. Folks, really appreciate you. Thank you as always for watching and listening, and I'll talk to you at the end of the week. Take care. Bye-bye.